Hello, everybody, and welcome back to another crypto live stream. Right now, things are about to get pretty crazy, and the thing is, we've got about 45 minutes left. So, for anybody that is tuning in later after the live stream is already concluded, or who's watching the beginning of the stream at some later point in time, because I have that turned on. Well, just know that this whole meeting is starting 10 Dubai time, 8 Netherlands time, or 7 UK time, PM obviously, which from right now is about 45 minutes. And again, what we're seeing, for anybody that's wondering, is Jerome Powell explain right now where the interest rate is going. It has a couple different parts. It partially is how much they're going to increase the interest rate, but we kind of already know that. We already know they're going to be increasing it by 25 basis points, or basically 0.25%. Everybody, if you're in the chat, just quickly say yeah, hi, or something like that. Just give me a little thumbs up or something, just so I know that everybody's in. But yeah, we already basically know it's going to be another interest rate hike of about 0.25 or 0.25% or 25 basis points. The thing is, that's because they always do it that way. They've been like consistently hiking. We're going to talk about that in just a second for so ridiculously many months. I think 10 months in a row. I actually have got it here. The Fed faces bank collapse and debt ceiling fears as it prepares to raise interest rates for the 10th time in a row. Oh, my days. Yeah, it's been pretty wild. And again, we have about 44 minutes left. Probability of an increase is 90% or so. And the way it's been moving is pretty wild. We also have it on the economic calendar. As again, I recommend you guys to tune in not only for the result, not only for what the interest rate is going to be, but actually for the half hour afterwards as well. Because usually 8:30, Fed Powell starts speaking, and it depends exactly the length of that speech. But generally speaking, he gives some pretty juicy insights, and the insights is what we're most interested in here. We're not as interested in what exactly Powell comes up with in terms of a number, because we already know, all right, everybody's expecting the number to go from 5% to 5.25%, the interest rate that is. What we care about most is how long will that continue? And people have been looking into the expectations of future prices, so you can actually do something rather interesting. If you go over to the CME Group website, you can actually check target rates, or I guess target dates, at different dates. I'm not sure if you guys can still see me. Everybody just quickly say yes in the chat. For me, it's actually stuck. Are we still good? Are we all still good? Test, test, test. Oh, Tommy says yes. JDV says yes in the chat. RT says yes, so I think we're solid. Sometimes it just gets stuck for some reason. I don't know why. Anybody, just quickly, where are you guys all watching from? Just let me know. I might have shrunk here a little bit. I don't know exactly what happened there. Need to maybe get a little bit up there. Hey. Where are you guys all watching from? Let me know in the chat box. Right now I'm recording this from the Dubai studio, as you guys know. We got it set up, you know. Ooh, sheesh. And also, I just bought matching pants for this suit. I still have the tag on. So again, the pants, I actually was always wearing different pants. Right now, as you guys can see, I just got it fully decked out, which is kind of funny. Just wanted to flex on that because I'm not a really big suit guy, but I'm getting into it. You know, it feels kind of nice. Return it after the stream. You know the drill, huh? Return it after the stream. There we go. Anyway, so on CME Group, you can actually find some very cool insights. You can actually see for all the different hikes, for example, the 14th of June, the 26th hikes, dates, meetings, and what the probabilities are going to be on that specific date. So here on the 14th of June, you can see there's a little bit of a probability shift. Again, there's a small minority of people who thinks it might be going down because, again, our target for this month is 525. So a lot of them expect it to actually come back down to roughly 5, which is peculiar. Afterwards, again, you can see it's pretty divided for the July meeting. And then for the September meeting, because that's after summer break, usually that one takes a little bit longer. The expectation is a very interesting one. It's very much divided. And so it kind of continues on the further in time we go. As well, we're not exactly sure how much they're going to be increasing it, or rather for how long they're going to be increasing it, because it can also be a little bit of a plateau where you don't really decrease, but you don't really decrease either, just stay flat. And again, all of this is going to, quote unquote, start today. Because again, we've got ourselves a meeting today in about 40 minutes from now. So we're going to do one thing, and that is ask you guys what you think is going to happen. Do you guys think that Bitcoin / the crypto market is going to pump or dump as we get this result? Again, the expectation is that we're going to be getting an increase of the interest rate, which obviously has good and bad sides. Let me elaborate. The reason interest rate is so scary is because it basically increases the cost of capital. That's simply put. So hypothetically speaking, let's say you are a management company, you're looking to actually expand your reign, and you want to actually get yourself a nice little construction going worth $100 million. With an optimal scenario, you've got yourself 0%, 2%, whatever, where the cost of now borrowing money to start your construction project is 2%. In this negative scenario, the cost is now 5%, which is a deterrent. So there's going to be less innovation, basically less production of all sorts. And so generally speaking, because things aren't going as well anymore, the inflation comes back down. It's a very oversimplified circle, but you understand the drift. So they basically have to keep increasing to make sure that, well, people just want to spend less and less and less. They have a higher propensity to basically put it onto their bank account and wait because, well, if you think about it, if you got a 1% savings rate, I might just spend the money today. If you got a 10% savings rate, I'm going to keep all my money on the freaking bank. Oh, you're saying glitchy. Oh, wait a minute. Why? Ooh. I don't know exactly why. Maybe I was moving too fast, guys. Can happen to the best of us. All right. I sometimes do some stuff like that. And all of a sudden, the camera might just not be able to keep up, you know? It's $5,000, obviously, matched with the $5,000 computer, but it might just not be able to handle. Sometimes it happens. Can I? Uh-oh. Audio keeps going. Image. Oh, wait a minute. I saw it. It actually says here I had some dropped frames. Why? That's a good-ass question. Yeah, honestly, this whole streaming stuff, I don't fully understand it. I don't fully understand exactly why sometimes it decides to take a dump on my head. Like, what exactly is it doing it for? Who does it want to go after? Is it the internet? Is it the computer? What? I don't know. All right, so we want to get our predictions in right now. Personally, I think we're in a little bit of a strange situation. And that's because right now the crypto market is in a quite interesting situation here. I mean, you can see we're quite neutral. Bitcoin's not really going too far in any direction. Ethereum, all these different coins are not really moving too much. A couple of coins like Solana are going down ever so slightly. And if we actually take a look at the double digits, we've got Rocket Pool in the double digits on the up and up, 10% up. And we've got Sui, which just reached an all-time high as it just launched, down 70 or so percent. And that's quite obvious, quite logical, as again, it just launched. Let me quickly see where I've got the article, because I did have something about Sui already open. So let me just quickly see if I can find it. Here we go. It is right there. So yeah, Sui token, which we've talked about for a little while. I wanted to make an airdrop tutorial, and so did I want to for many other crypto projects. The problem is, though, I speak to these projects most of the part, or my friends invest into these projects, so they have insights. And so what I knew about Sui was the fact that I was thinking of making a tutorial March 13th or something like that, about a month and a half ago. And the thing is, people are telling me, Dusty, it's going to be too late. And at the end of the day, it was the truth as well, because the cutoff date to actually get yourself some Sui to be able to buy it, because it wasn't a free airdrop, was somewhere over in February. And right now, I've been going to a lot of these crypto events, as you guys know. And now for a lot of these projects, they're telling me the era of free airdrops or airdrops of the sort might be over. And so I'm more hesitant to give you guys a full-on airdrop tutorial as, well, let's say you go fully through an airdrop tutorial. You do every single step. It might cost you $100, right? To fill out every single step. It might. And I personally think, rather wing it than not, because you might just make yourself a juicy amount of money. But what if the probability of them actually airdropping something is so ridiculously small that you're just basically wasting money? So it's kind of like an ethical little dilemma there where I'd rather not waste you guys' time and money by following a different elaborate tutorial when I've heard from all these guys that it's not going to happen. So it's just a waste of time. But for the most part, if there's a probability of them actually launching it and it's a pretty good one, I will go for it. So don't worry about it. If there's some juicy chances, I got you. I always try my best. One other thing I want to quickly say here is I'm going fully degenerate on meme coins. Even right now, there's one thing I'm keeping my eyes on, but I'm not say it for the next 30 minutes or so. But you're going to know about it just soon enough. I've been eyeing so ridiculously many coins, and I put on Twitter, just comment a coin down below, I'm going to buy it. I've already spent tens of thousands of dollars trying to buy a couple of gems that are undervalued. And I'm going to tell you, a lot of it hasn't worked out well. Because, honest truth, if you're buying meme coins that are already established, it's a roll of the dice type of game. And honestly, it can be mentally draining if you don't have the capacity like I've got here. I've been so used to losing money. It ain't that big of a deal. But for the most part, I can't necessarily recommend people to trade meme coins or buy meme coins because it's not good for the brain, I think. But it is pretty funny. And honestly, the amount of money we've made over the last, I'd say 2.5 weeks is pretty severe. And so I'm just going to keep trying it out. And again, the philosophy there is I'd rather spend $1,000, $100, $1,000 trying a meme coin out, trying to make 10,000 rather than not trying at all and not winning anything. Because I'm like, the money, the $100 that I spent on the meme coin, I'll make back. But the chance to 100x it, that won't happen as often. So I usually just try my luck with all these things. And very often, again, it doesn't work out. But sometimes it does. And that's what we're in it for. Then again, if you got recommendations for meme coins, just let me know down below as I will look into everything, obviously. There's some other cool things going on. So one thing that I think was quite peculiar was the guy, or at least one of the guys, that was involved in the FTX lawsuit trying to get away from the lawyers. So a guy, I don't know his name, but his name was Tom Nash. There we go. He was a YouTuber. And apparently he's also been sued by the same company, the same lawsuit that's also suing BitBoy and suing a couple of the other guys like Brian Young. And apparently one of these guys, Tom Nash, was really not feeling it. He's like, you know what? I'm going to just not respond to any of the mails that these guys sent to me. And a funny thing is, apparently the judge said, you know what? Yeah, we're going to make sure that this person sees it because we're also going to make sure that Twitter is allowed to be used. And so the guys over at the law firm just tweeted out at him. And he probably saw it, or at least it was good enough as a warning as the guy has an online business. So he should have seen that, which was quite peculiar. I was quite amazed by that. It was pretty funny to read. All right, so let's quickly do a little summary as the entire FOMC meeting is 30 minutes out. There are two different things I should mention. One is we're waiting for the result, even though the result is almost certainly going to be what we expect, 5% to 5.25%, so a 0.25% increase. We then are waiting for 30 minutes afterwards, which is the FOMC speech, basically the speech where, again, Powell, let's quickly go to the sheet here, explains, this is called the Fed press conference, exactly what they think is going to happen in the near future. The Federal Reserve is expected to raise the Fed funds rate by 25 basis points to a range of 5.25% during its May 2023 meeting, marking the 10th increase and bringing borrowing costs to their highest levels since September of 2007. Still, uncertainty persists regarding the future rate path due to sticky inflation on one hand and potential economic repercussions from recent issues with regional banks. We're going to talk about that in just a second. On the other, the headline inflation slowed down, but remains more than twice the central bank's target, and the economy is exhibiting signs of strain. The GDP growth in Q1 was significantly lower than anticipated, and the earnings season has so far shown a decline in earnings for the second consecutive quarter. And so the expectations right now are just not that beautiful. As we said before, it's all about the expectations. It's all about the sidelines. It's all about what they say on the side that matters the most. Just so you guys get in on that. Sorry, I accidentally removed my stream. Clicked something wrong. You guys are still here. We're all good. Are we still here? Yeah, we're still here. Sometimes I do this, guys. Sometimes I just mess up my stream. It can happen to the best of us. It can really happen to the best of us. Anyway, let us look at what I just said. The Fed faces bank collapse and debt ceiling fears as it prepares to raise the interest rates for the 10th time in a row. So, what's going on that department? Can I also do a full on? Let's see here. What do I got? There we go. That's pretty good. So you guys could just quickly read with me on this one as well, because I don't think you need my face for this one, right? I don't think you need my face for this one. So on the, what do we want to start with this one? I've already read the article, and I've actually given you guys the rundown already, but I'm like, you know what? We have another 30 minutes or so to fill, and for the most part, it's just fear all along the board. There's a little video. I'm not sure if this video actually changes every single time you refresh. Uh-oh. Why does that happen? Can you guys see that or no? For me, it's just this YouTube thing going in the middle and then getting back out. I didn't click anything. It just sometimes glitches out. Whatever. We'll just go like this. It's fine. Anyway, Goldman Sachs estimates that a widespread pullback in bank lending could cut the U.S. growth by 0.4 percentage point this year. That could be enough to cause a recession. In December, the Fed projected growth of just 0.5% in the whole year of 2023. And the Fed's likely rate hike today comes as another major central banks are also tightening credit. The European Central Bank President Christine Lagarde is expected to announce another interest rate increase Thursday, after inflation figures released Tuesday showed that price increases ticked up last month. Consumer prices rose 7% in the 20 countries that use the euro currency in April, from a year earlier, up from 6.9% year-over-year increase in March. So generally speaking, the inflation is still ongoing over in the Eurozone, which obviously is not what we want. In the United States, although overall inflation has tumbled as the cost of gas and many goods has eased, core inflation, which excludes volatile food and energy costs, has remained chronically high. According to the Fed's preferred measure, core prices rose 4.6% in March from a year earlier, the same as in December. So from that perspective, the U.S. is on a good path forward, but I'd like to say that that's not exactly the truth. I mean, again, it just depends a little bit on perspective. We're all watching right now with the perspective of, well, from the regional bank's perspective, it's just not going that well. So they can say, hey, you know what? It's the inflation rate is coming along, so our policy with the interest rate is working. Well, I guess clearly not. And there's also apparently clearly some division among Fed officials, which is reasonable given that we don't know where we are, and we've got these things going on in the wrong direction," said Dion Schwank. That's a nice Schwank. Why did I do that? Chief economist at KPMG. Yeah. Anyway, right now there's a lot of speculation as to how high the interest rate eventually is going to be. We've also been looking at cryptocurrencies and just been wondering, when exactly will Bitcoin finally make that final push? When exactly will it decide whether or not it's going to break down again or get a juicy pump going? Again, right now, this is one of the most interesting points that we're watching. We also have got another one, which is the crucial, determining zone for Bitcoin. You can see, for the most part, we are rating right now for a switch in paradigm, where I'd say that this entire area, the one that we're facing right now, has a couple of different specific points, but this entire area that we're trading in right now, this range, is the determining area. Because the moment that we break above and we finally get some confirmation for that, we're in the bullish area, we're in the bullish zone. Right now, however, that's not the case. We are still in bearish territory, at least in uncertain territory. We need the proper cross before we can finally start rejoicing. And again, I want to put quickly into perspective the fact that I personally don't think it. Let me rephrase that. I personally think the bull run, the way a lot of you guys see it, is actually already started, or has actually already started. And what I mean with that is, if we take a look at what we've seen between the lowest point of a good while ago, March of 2020, and we saw the way that the price increased. I always like to put it on a logarithmic chart, but we can just do it like this. And we saw the way the price increased. We don't even look at the actual percentage here. We just look at the fact that it took about 616 days. All right, so that's the amount of time that it took-ish to go from this low point all the way up there, plus minus a little bit. And now, if you, let me just quickly do that back. If you now take a look at the lowest point. Just bear with me here for a little second, guys. Lowest point from 2020, highest point of 2021. Took about 616 days. If we take the lowest point of 2022, which is the end of 2022, and if we project, again, a similar amount of days, that will put our all-time high all the way here in the future at way further into 2024. And I can actually see the date for some reason. Not sure exactly why I messed up on that department, why this date is so stuck. I'm not exactly sure what is happening right there. Maybe you guys can see as well that the date is not working anymore on this one. The couple strange things are working on or going on with this chart for some reason. But I can quickly zoom in and show it to you. Here we go. So that would put us at roughly July of 2024 as an end result for the major high. All right. And the thing is, this also coincides a lot with the halving cycles, which we talk about quite often on the channel. Let me just quickly grab them here and show them to you guys. Bitcoin halving cycle. It's just a cyclical movement that I like to believe in personally. A lot of you guys don't like it at all, but it doesn't matter. I personally think that if you just hold quite true to it, it's still pretty easy to just make juicy gains. If I can quickly, hopefully, show you any specific chart of anybody putting the halving in. I also have one of my charts where it's inputted, but I don't know which one anymore. You know what? Let's look together here through a couple of different charts. I guess we'll just quickly try to find one of them at least. Or we've inserted the halving dates into the chart. Hopefully we can see that real quick. So just give me 10 seconds here to look it up. I might have lost it amidst the journey though. It's definitely possible. Yeah, I'm just going to assume that I don't remember exactly where it is. And the reason that's the case is because I have just too many charts open. Oh, there we go. All right, we've got one. So what this puts into place is all the specific dates for the Bitcoin halving. All right. And what happens again is the Bitcoin mining rewards are halved. Now, if we take a look, you can't see it perfectly. Let's put a logarithmic chart on this so it's easier to see. Usually going in to the halving, we've got ourselves a pretty juicy pump, right? You can see it right there. We've got a pretty juicy pump. For a little bit, we've got a pump. We reach an all-time high before falling down and continuing on with the cycle. Again, going into the halving, we've got a pretty juicy pump. Right afterwards, though, we go quickly to an all-time high before getting a new low, in this case here at the moving average, before eventually heading back into a new halving with a crazy pump getting into the halving. You can see it right there. These last couple of weeks, the last couple of months are crazy pumpy going into the halving. Again, this is a 4-year cycle before hitting an all-time high, which again here was a kind of like a fake out, which I don't think we've seen. Oh, yeah, we've seen it once before here as well. Let's just call it a fake out before hitting an all-time high, before coming back down lower. In this case, even below the moving averages, making a low, and then potentially now, or potentially a little bit later, pumping up into the halving before continuing on to set a new all-time high. Again, potentially a little bit later even than I just told you at July of 2024, but at least from that point on forward, from I'm going to say February or so of 2024, it's just most likely going to keep going bullish and most likely a lot more significant than a lot of you guys seem or think. At least I personally think that that's the case. But hey, that is just my own opinion on the matter. Let's see. Are any of you guys buying meme coins? Just a little question. Any of you guys getting into the juicers? Meme coin buyers in the chat or no? Nope. All right. Don't worry about it. Buying meme coins is a risky thing. So don't worry. I don't think it's a bad thing if you're not buying them. Oh, yeah, by the way, I just told you guys, the reason things are right now in a pretty crazy situation obviously has a lot to do with the U.S. banks as well. Data shows more U.S. bank failures are ahead. Who will the SEC blame now? The U.S. economic catastrophe is almost here as the Fed continues rate hikes amid recessions, bank crises, and debt crisis. Yeah, have you guys read everything about the U.S. debt ceiling increasing or needing to increase? We've talked before about how right now they're approving everything in that nature because, well, they've got to. There's almost no more choice that they've got. And that's obviously, again, coinciding with everything that we're reading right here. The fact that everything's getting crazier and crazier by the day. Dre says, dude, are you not seeing the chat? There's literally meme coin traders here and you didn't see. I do see, but I was just wondering about the rest, you know. There's sometimes only a very vocal minority. Somebody's saying Poo coin a little while ago. And again, I have let me show you. I always have the chat open right there, right? Let me show you. So I always am reading everything. But if I see, you know, a couple people talk about Poo coin, still makes me wonder if most people are into it or if it's just one or two people in the chat, you know. So that's why I'm just asking everybody to include everybody into the conversation. Then I also know if I should talk about it a little bit more or just skip it altogether. Because if everybody says, screw meme coins, that stuff is disgusting. I probably won't talk about it as much. But if everybody says, oh yeah, let's go. Obviously, then I'm going to try also include what you guys like a little bit more. A lot of you guys are saying, no, fundamental coins. Somebody says, or Cherry says, if you're investing in something that is up 2,000% recently, then you aren't very smart. I am going to half agree with you right there because the only caveat to that investment idea is that what if you just buy it, however, before it increases another 2,000%? Because we have to put into perspective here that you're not buying a coin here for the fundamentals. You're not buying a coin like Sui. When it launches just now, it's up 2,000% and then it comes crashing down. You're buying something which you're hoping that more people will buy for more. Let's quickly take a look, just for fun. I'm going to grab something here and you guys will say, okay, I'm going to do something really funny here. You guys tell me if this would have been stupid or smart, all right? If this would have been a 1,000 IQ play or if you would have actually have the brain cells of a baby, right? A very tiny, whiny baby. So let me quickly take this up for you. All right. I've got it. But it's probably not the, oh, sorry. Wrong one. Here we go. This will probably work. There we go. All right. There we go. I'm just zooming in now. We're getting there. Don't worry about it. I got you. I'm just looking for. This is pretty peculiar, actually. I'm trying to put a good example forward here, but I'm trying to look for the best one. But for the most part here, it kind of looks stupid. You know what this will have to do? It will have to do. It was actually, I'll just explain it to you guys in theory here. It was about a Shiba Inu. So, let's say, because again, I'm not going to make it secret anymore. Let's say you see this price. Okay, it got listed on this exchange. I think this might be a listing on a lot of different places. Boom, it goes to whatever freaking dollar number that is, a very nice decimal, comes right back down and starts trading in this little range here. And all of a sudden, you see the coin go from whatever 6685. Oh, it goes up like crazy. Goes a 4x. It goes to 34,800. You can see it right there, right? Somewhere along this point, it's done the 2,000%. You know, I guess it's a little bit earlier, but it was a lot cheaper before. I just can't find it on any of these major exchanges. I'm going to have to dive even deeper, but you understand. At some point here, it's going to basically look like a really stupid investment because it's up maybe a couple 100% or so in a couple of days. And I'd agree with you because, well, it's pretty stupid to buy something that's been going on that trendy for such a long while. But as you extrapolate, you can see, well, the price did go a very significant amount higher a little bit afterwards as well. Because you can see, if you bought at the start there, boom, 450% gains, people would be crazy happy with that. But if you held on for a little while, you can see the higher part of this climb. Because that could have actually been about 2,000% gains. And from the same perspective, you know, buying at 2,000% gains like with Pepe is kind of dumb because, well, you might be buying exactly this top right here. But you might conversely also be buying this top. You just don't know how long the story is going to be lasting. Again, these things you don't hold on to forever. I personally say try to just sell pieces along the way, try to make money along the way because, well, otherwise you're going to be just seeing the price deteriorate over time. You don't want that to happen. Then again, there's good money to be made if you're buying it right on time. You know, anywhere here would have just resulted you in crazy amounts of gains. And this is still, this time period here is, you know, 150 days or so. Let's just call it 5 or so months that you had to accumulate the crypto. to actually still make crazy massive amounts of gains. So right now with Pepe, if we look it up, I'm not sure if we can already find it here. I guess we can. Can you guys see me again? We're good. What was that? That was interesting. So we've witnessed something new. Why did my computer just fall out? OMC coming in at the $10. He says you crashed, STBC. Why did that happen? I'm trying to figure out a little bit of context here. Why did my computer just break itself? Sketchy, not to say the least. Extremely sketchy, but I guess we're gonna have to deal with it. It is what it is. Why did that happen? All right, interesting. Maybe they're doing this because they don't want us to stream the FOMC meeting. That might be it. You see, they knew we were gonna make some crazy amount of money, so they were not. You know what? They were like, let's shut this guy down. He's exploiting the fact that our system is crashing down. And all of a sudden, they cut me off. Now, I don't know exactly what happened right there. Everybody, if you've not done it yet, make sure you press that like button. I have to sit up tall when I do this little camera right now. I do not know exactly what I did, but I messed up my camera somewhere. Maybe that's what's crashing my computer right now. If you've not done it yet, make sure you press that like button. Why? Yeah, do not really have a good incentive for you. It's just like, it would be pretty nice. You know, I would appreciate it. And that's about it. I can't really do too much for you, except sit here and broadcast everything that is coming through. Yeah, that's about it. Yeah, that's about it. I've also been discussing with a couple of loyal viewers, a couple of you guys over in Telegram and actually over in Discord as well, if we should be doing more live trading streams. A lot of you guys were in for that because the last couple of weeks have been so insane. I might actually make that a thing where we just go live a couple times a week or so and actually do some live trading sessions, potentially even every day if you guys are fans of it. But I do need to see some support for that in the sense of I want you guys to comment then in some video, whatever, that you guys would like to see that type of stuff. Because then I'll get to it. It just depends, right? As I said before, I like to cover so many different things. I like to cover the news. I like to cover some of the trades, some of the investments that we make. But for the most part, I just look at what exactly do you guys like to talk about? You know, what do you like to see? And there, we kind of go from there. Relic says, yeah, I'd watch live trades again because we've got some juicy stuff. Let me see if I actually can open something on the PC right now. Let's see. Fun fact, we're also still in our position that we opened last stream. Let's quickly see here. Because I don't think I've closed it because I'm a little I'm a little bit slow with that type of stuff sometimes. You know that? Let's see. Oh, but our position is very, very minimal. We're $50 in the profit now, unfortunately. So it's actually exactly at our buying price from a little while ago, when we did the stream. I think actually last time the FOMC meeting came, I told you guys, let's just do again where you guys tell me what to buy, and we put $5,000 into it. That's what we did last FOMC, and it worked out great, inversely. If we did exactly the opposite of what the chat said, we would have made a couple $1,000. But unfortunately, and I would have given it away to you guys. But unfortunately, we didn't because apparently the chat is not good at trading. So yeah, we might be doing we might be doing that. We might be doing something else. Dusty, you missed my donation. I don't think. Let's see here. Dennis Vlog. Oh yeah, see. Yeah, I did. He says with euros, where do you think Doge Elon Mars could go? You serious? I'm not so sure if you're serious about that. 10 more minutes to go, everybody. We've got 10 more minutes until the FOMC meeting results are coming in hot. Hot, 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 hot. Let's quickly put everything into perspective here because I've been messing up a little bit. Let me quickly, juicely get this out. And perfect. So, yes, let's quickly see here if we can, because everything's now got to load back in because, the computer messed itself up. So here we go. Yeah, right there, you can see this is happening in about 10 minutes and 11 seconds. And what, again, is going to happen is we're going to be seeing the interest rate number. It's as simple as that. It's as deep as that. The interest rate number is going to be showcased to us. I'm just quickly checking a couple of different ones here. Also taking a sip of my drink. A lot of you guys said, please mute your microphone. And don't show us when you're drinking something, so sometimes I do not. Yeah, just to prevent, people hating the ASMR. All right. But right now we're just waiting, guys. We're just a couple minutes. I'm not sure how far my story could still go because there's a lot of interesting stuff to look at. But for the most part, it has to do with this specific meeting. And it always going to depend on exactly what comes out of it. In the sense of, yeah, we're talking about the fact that banks are not doing good. Yeah, we're talking about this. This picture, it's so funny. Former SEC senior official warns exit Binance. Now, I got pretty scared by the fact that they're writing this from the different perspective, though. It's only in the sense of the SEC or other entities might be going after Binance next. I'm not really afraid that Binance is going to exit us or do something really sketchy because they're in too good of a position for that. I think yesterday or the day before, I read an article that showcased just how good of a position Binance is in right now. And from that perspective, I'm thinking, man, if they really mess up and do something dumb, it would jeopardize everything that they've built, so they probably won't. It just doesn't make sense. What, however, is possible, what is feasible, is for Binance to eventually be caught in the SEC's grasp, right? By their surprise attack of sorts. Let me also quickly go ahead and live stream the fact that we are live. Tweet out the fact that we are live. I actually forgot to do that. I think right now is the most important point, though. Interest. I'm just going to tweet out interest. Going to tweet that we have the interest rate review in 8 minutes. And send a tweet out as well about the fact that we are live right now. There we go. Put it onto Telegram. And onto Twitter. I'm just sharing the stream with everybody. Again, if you're retweeting that, you're an amazing guy. You don't have to, though. But just know you're pretty amazing if you do that. Live FOMC meeting. There we go. Dusty, check this project for us. I don't know what that is, my friend. You just want me to check it? Number 6,000 in the ranks. Nah. I might be able to check it out, but not here. I could give it a look for you, my buddy. But like I said, not today. Nah. What's also annoying is that your charts don't properly save if your computer just decides to shut itself down. So I'm not so sure exactly everything that we had open or the story that we had, but it's going to be fine, right? We knew the most important, most major parts of it all. We've got a 5-minute countdown. Let's go to economic calendar. Again, 5 minutes to go before we've got ourselves the interest rate numbers over in the U.S. And as you guys know, it's going to spell the start of a couple of very important things. Tomorrow, however, we've also got the ECB's interest rate decision at 2:15 p.m. I don't think I'm going to be streaming that because it's not as important, but usually it's still quite interesting to just have on your vision. You can see here the most impactful ones are obviously always the Fed interest rate decision and the ECB interest rate decision. And the press conferences are usually nice because you see kind of what their stance on things is, what their thoughts on things are, but they're not as important. They're just like kind of like nice ones. I just like to follow it, but maybe it's because I'm a geek of sorts. Maybe I just like the info. The ECB one, right? The FOMC one or the federal one is for sure important. 100%. You have got to keep yourself up to date with that. Again, we've got 5 more minutes, everybody. 5 more minutes. Everybody in the chat, just do a little fun real quick. How many of you guys are holding XRP? And how many of you guys don't like XRP at all? Let's just quickly see what you guys think about that. As we have a couple minutes to go. Sean says, what does a little Casper love? What about a little Casper love? Casper, I met those guys a couple days ago as well at Consensus over in Austin. I'm going to just take a little sip of some energy here. John says, Dusty, what's your Instagram? I think there's a scam. One thing I want you guys to understand is I'll never DM you. If somebody's talking to you over on Instagram, over on Twitter, wherever, it's probably not me. It's as simple as that. If somebody messages you on Telegram, it ain't me. And I get people texting me, hey, Dusty, you've got an imposter every single day. And I know because there's hundreds of them and there's nothing I can do. I've tried many times, but there's nothing I can do. So all I can tell you is be sensible with this and understand that I'm not going to text you about a freaking investment opportunity. I'm not no broke. I don't want your $60. Please, it makes no sense. I'm not going to text you, hey, to activate your account, please send me $60 because that seems to be what the scammer is doing. Don't fall for it, all right? Troll the guy. Please waste their time if you have time available and if you enjoy some sadistic stuff where you like to just, I guess waste their time and hurt their feelings. I'm supporting you in that department. If you want to or can waste their time, it's a fun thing. Then again, understand that their time is less valuable than yours. So maybe just make money instead of, entertaining them because I guess they don't have much to lose. Otherwise, they won't keep doing this. Opposite way, they have a lot to win by fooling people, but there's nothing we really can do. All right, let's see. A lot of you guys are XRP fans. Somebody says, come on, Judge Torres. Justice delayed is clarity denied. Well, at least the justice delayed is freaking awful, but yeah, it's eventually coming. The DXY going to 0. Honestly, the way it's looking right now, the dollar and the entire U.S. stock markets, they're not in the best of positions. It's truth. They're not in the best of positions. Jeremy says, holding a nice small bag of XRP. All right. It's funny as well. The more people I meet right now that are, not necessarily Bitcoin maxis, but crypto maxis, a lot of them all of a sudden have started to switch up on XRP. A lot of them are a little bit more open towards the idea of holding XRP or open towards the idea that it might actually be a wise idea to open up to the possibility of potentially getting yourself a hand on a little couple of drips of potentially some XRP. Kane says, Dusty, can you read my comment above XRP? About XP, please, I beg. Kane said, can't see your comment, my man. Kane, Cherry says 25 or pause. Yeah, again, right now we've got about 2 minutes left. It is, let's actually head over into let's go different chart, a little cleaner one. Because right now, Bitcoin is actually already starting to move. It is back at a 50 moving average, I think this is. Oh, there's actually the 200 moving average, okay. But is it a 1 minute one or did I update it? Okay, so it's a 1 minute. Interesting. Yeah, I guess we'll keep it the chart. So this is the 1 minute 200 moving average. That's interesting. But we just got ourselves a tiny little dip in Bitcoin price. As again, 2 more minutes. It went down about 1% in price. Rebouncing or bouncing back off. A lot of you guys want XRP on the side. We can do that. XRP not as liquid. Here we go. 1 more minute, everybody. And by the way, I think, if I'm not mistaken, that one of the fun coins we talked about for a little while is actually also launching right now. I'm keeping that open on the side because I'm not 1,000% sure, but I believe. Oh, I'm not even. Why didn't anybody of you tell me that I didn't have the proper? Sorry, I didn't have it open, huh? One more minute. I am keeping it on my phone. You can hear the little tumbleweed. It's loading. It's loading in. Some people might have already known.
In the financial system.
Why is this happening? $25 basis points. 25 basis points. There we go. My phone had refreshed. Here it's not refreshing just quite yet. 25 basis points. Like everybody was expecting, 25 basis points increase. Hey, Bitcoin XRP pump it a little bit. Interesting. Interesting. The most expected move ever. Not necessarily this pump, but the fact that the basis points came in this hot. Woo! Oh! Oh, panic! Let's go crazy! We didn't expect this at all. This is insane. Bitcoin is coming down. No. United States. Just quickly tweeting it out and also getting it to everybody over on Telegram. Because a lot of people don't have time to watch no streams, right? But they might be getting their notification. So I try to update everybody in the same fashion. There we go. Damn. Yeah, pump and dump. Why? Because it always happens in the exact same fashion. Honestly, not the big move that we were expecting. Potentially because it was so expected already. Now, one thing I want to tell you guys again, over in 30 minutes from now, there is going to be the Fed speech. And we all knew that this number was going to come out in the exact fashion as it did. So it's not important. What's important is what's happening in 30 minutes from now. Again, Fed is going to explain what's happening in the future. And as we knew this number already, that's not the big part. Let me just quickly see, however, what's going on. Everybody's going crazy right now over the idea that an FOMC type of token was launching. That's what everybody was telling me. But I'm honestly not seeing anything. So I'm just looking into it on the side here while our tokens trade a little bit sideways. Are any of you guys trading crypto right now? Any of you? Again, I'm just always reading the chat, you know, just seeing what you guys are saying here. Short, he says. Soon, he says. Somebody explains what he likes to see more content of. No. All right. I don't know. No, nothing crazy in that department. Again, what we're looking for here is a couple of meme coins that are related to the FOMC meeting. I thought, potentially things might be going crazy. But you have to understand, there's still about 30 more minutes worth of juice. I was going to say about an hour worth of juicy content here as the FOMC meeting, which comes out in a bit. Usually we watch it all the way through. I don't know exactly how long it takes, to be honest. Every single time it's quite different. It's just going to be, he's going to explain their future projections. And then slightly afterwards, we get a question round where all these guys ask the most generic dumbass questions out there to our mister. I think the coin that I just talked about might actually be launching. Again, just so you guys know, I buy a lot of freaking degenerate things. So on a day like this, how many coins do I buy? I try to buy at least 4 or 5 or so that have to do with something special. The reason I do that is because, again, like I said, the mathematics makes sense. For $100 a project, you either lose $500 or make $5,000. It's like, well, or make maybe $25,000. But most of the time, at least one of the projects does well, but 4 of them fail horribly. And very often, I'm a dumbass. I sell too late and then no money. Or I buy in too late, which sometimes happens. Like, for example, with Pepe, I was very late to the party. And I actually didn't really make too much money on it. But it was pretty well. And like I told you guys, some of the other memes were just doing awesome. And other ones I missed out on. Like the pizza one, I didn't get a single coin. Doesn't matter. It's not a big deal, right? Don't worry about it. We still will get another one, and another one, and another one. That's the way I think about it. Because right now, again, it's the season for it. And that's also a potential explainer as to why the entire market cap might not be in the, or at least Bitcoin's market cap might be in a strange situation. We talked earlier about how Bitcoin's dominance is in such an interesting spot. Because even though it's increasing like crazy, it's actually gotten above its 720-day threshold. It's made a close above that last week. Right now, it's falling back down. I think that it might actually, for the most part, be getting into meme coins. Let's actually see if we can find memes right there. It might actually be heading over into meme coins for the first time ever, as a lot of these ones have been doing quite well. Again, in terms of numbers, it's hard to put because you've got here one that's in spot number 3,000. I don't even know about the majority of these, and a lot of them are still going down. All I mean to say is there's a lot of these coins probably in here that are taking up a lot of that market cap, even though it doesn't potentially showcase it, but there's a lot of money going around in that. And it's just the fact that I'm not really seeing it into a lot of these major altcoins, yet Bitcoin's dominance is going down when none of these are really going up. So actually, for the most part, most cryptos are going down a little bit more than Bitcoin is. So where exactly is that money going? It might be for a small part into these meme coins. It's possible. Another little side note is Balaji, the guy that had $1 million bet that Bitcoin was going to go to $1 million in 90 days. He actually quit his bet. He said, you know what? Let's call it quits here. Let me donate $1.5 million to some charity out there. He agreed with it with the guy that he bet $1 million to. And the thing is, a lot of the people are already telling me he's not serious with his $1 million bet, but I don't know why that keeps happening, guys. It's just annoying, but it is what it is. He's not serious with his $1 million bet. All he does this for is for some publicity. And, well, yeah, it does make a lot of sense. It does make a lot of sense that all he's doing this for is just some publicity. $1 million is a lot, but if you look at it from the perspective of the fact that the guy is buying into so many pre-sales, and right now, whenever he tweets out, people give it authority. I can't. Let me just quickly try to find it. If you look over at his Twitter, you'll see that all of a sudden, 900,000 followers. Every single tweet he posts has hundreds of thousands of views. Now, $1 million might be a lot to a lot of people, for sure. But this amount of marketing that now gets you 1 million views on every day, everything that you say every single day, it's a pretty good deal. All right? It's a very good deal even because it's way more lucrative. Again, I like to follow these guys. The FOMC meeting is concluded in the sense that we've got our interest rate decision at 5.25%, an increase of 0.25. We right now are waiting another 22 minutes, for Jerome Powell to start his speech. Again, a speech for anybody watching, a speech is starting in about 22 minutes from now. Yet again, a speech is starting in 22 minutes from now, which is the only important part that we were waiting for. Like I said, I follow guys like Balaji religiously. And not what they say. No, I don't care about what they say. But I follow more of what they do. A little while ago, I told you about a coin, right? This one. Now, from the price that I told you guys to buy it, it pumped a significant amount. But again, I'm not a financial advisor. And anybody could have sold for a juicy amount of profit. But alas, the reason I bought into it is like I explained over in my Telegram. Balaji's invested, a couple other juicy guys are invested, and that's the way I like to go about my investment strategies. Follow the big guys and follow where they put their money at. Don't listen too much to what they say. Balaji, again, he's a guy that's been screaming, hey, I'm betting $1 million that Bitcoin's going to go to $1 million. Well, I mean, it was all bullshit, so Okay, we shouldn't have listened to that. He's not been saying, hey, this, that, this, that, this, that, this. Is he all saying this because he really believes it? Because a lot of it does make sense. Or is he saying it because he just wants the attention, and that's why he's saying such controversial things? Or is he being contrarian by stating such heavy things like the U.S. is going down, the recession is going to go crazy, just in case it happens? Because, again, if you think about it, it's pretty profitable to be a guy that says, you know what, it's going to all go down. Because even if it doesn't, you can always say it should, or that they're manipulating it, yada, yada, yada. Right? You can always keep saying that. While in the end, nothing happens. Let's quickly see. We right now are again waiting about 20 more minutes until the FOMC decision as to what they're going to do in the near future. Prices are a little bit volatile, but honestly not too crazy. You can see we're up about 0.3% on Bitcoin and up about 0.3% on XRP. The entire volatility in the midst of that was about 1.1% or so. But I guess we're right back to prices where we were at the start. So really, it hasn't changed too much. Nothing too crazy is going on. And honestly, it's not too far from expectation. The only thing which I'm mostly interested in is what we're going to be seeing for the FOMC speech. Now, it is going to be rather long for some people, because some people have no patience. But it's the most important part. I think any single article, let me quickly take a look. I think every single article that I had was saying that same thing. That because we all know it's going to be going from 5 to 5.25, because again, it was quite logical, that the only important thing was the speech afterwards. But I'm not so sure exactly which of the articles was stating that. Anyway, this one is pretty cool. So, right here. On the one hand, turmoil in the banking sector and political battles over the government's borrowing limit could weaken the economy if banks restrict lending, if financial markets tumble on fears of a default on the nation's debt. Such anxieties would argue against further rate hikes, at least for now. But right now, again, we've already seen a rate hike, which is the 10th time, but we knew it was going to happen. All right. So, on the other hand, inflation, while slowing, is persisting at a level far above the central bank's 2% target rate, raising concerns that the Fed might have to further tighten credit to slow price increases. Additional rates hikes would follow, a trend that would lead to ever higher borrowing rates and heighten the risk of a recession. The wide range of potential outcomes could provoke divisions among Fed officials, which we've already seen, even as they're expected on Wednesday to raise their benchmark rate to 5.1%, the highest level in 16 years. The big question is whether the Fed will also signal Wednesday that it is now inclined to pause its rate high increases, which basically means, again, like we're going to see in about 15 minutes from now, whether or not from here on forward it's going to stop, barring any reacceleration of inflation, and keep its key rate unchanged for the rest of 2023 as it assesses its progress in cooling inflation. Again, what it tries to do is see how exactly the inflation matches up, which is a lagging indicator, by the way, but kind of pivot from there. Quote, there clearly is some division among Fed officials, which is reasonable, given that we don't know where we are, and we've got these things going on in the wrong direction, said Diane Schwank, chief economist at KPMG. Austin Goolsbee, president of the Federal Reserve Bank of Chicago, last month cited the banking turmoil and the likelihood that many banks will tighten credit for consumers and businesses as a reason to potentially forgo a rate hike this week. I think we need to be cautious, Goolsbee said. We should gather further data and be careful about raising rates too aggressively, which obviously you don't want to do because that way you get into a heavier sort of recession. And now we've been following along, hopefully you guys have too, with some of the guys like Watcher here. Let me quickly see if I can grab that over. That have been posting a lot about, let me quickly see if I can find it for you, a lot about these major, let's see if we can find it. I want to say bank crises, but U.S. presidential candidate RFK Jr. says the banking collapse is the tip of an economic mega crisis from Mr. Robert F. Kennedy. Bernie Sanders says income over $1 billion should be taxed at 100%. Wait, what? Huh? Did I just read that right? That's interesting. Apparently, over in Florida, the governor vows to ban CBDCs in the state and says the government doesn't like crypto because it can't be controlled. I mean, obviously, that's why we love crypto, because they can't control it. So, yeah. A CBDC, they can control. But I guess it's mostly in the central bank's control, which, again, is then controlled by the government. So, I'm not so sure exactly why that's said that way. Like we were saying earlier, U.S. Representative AOC and Matt Gaetz introduced a bipartisan bill to ban Congress members from trading and owning stocks. And we've also seen a little bit earlier, all these U.S. regional banks just going absolutely haywire in a negative way. U.S. regional banks stock following collapse of the First Republic Bank, FRC. And you can see a couple of the names of banks that were doing really freaking awful. And again, right now, we've got a couple more minutes left until the official FOMC little meeting right here. Yeah, about 15 more minutes. So let me quickly grab it up as well. FOMC meeting. Hey, there's actually also some live coverage here as well. I guess maybe they're going to just show the stream and just write underneath it whatever important parts come out. Not exactly sure. The increase takes the Fed's fund rate to target range of 5 to 5.25%, its highest since 2007. Live stream will begin in about 12 minutes from now. Fed raises rates by quarter point and hints at pause. All right. Officials call the U.S. banking system sound and resilient. That's funny. That is really funny. And the stocks are steady ahead of the Fed's rate decision. Let me, as I said, quickly go find the official stream. FOMC meeting. Usually there's one official Federal Reserve link. Here we go. I think we've got it. No. It's somewhere on the Federal Reserve website, but it's always kind of like a little look around. You always have to kind of loop around a little bit. If any of you guys have the link to the video, just send it over. Otherwise, we can always watch another stream in the sense of, like, for example, Barron's is always going to be streaming it and some of the Wall Street Journal, etc. But I think from the government itself is always a little bit. Yeah, here we go. I found it. We're good. Oh. I'm not sure if you guys could hear that banger, but it's juicy. Oh, it's juicing. Damn. So again, let me quickly set everything up as well. Let's quickly hope that we've got a good way to view it. I think that should work. There should actually be an even better way to do it. Nah, I don't got it, I guess. I'd hope that I'd have something a little bit better. But this is the best that I've got for right now. All right. So again, we're just waiting a couple of minutes for this to tune on in. I'm just going to be chatting with you guys for a couple of minutes as we wait. Another 13 minutes or so. All right. So anybody? Oh, somebody says we're pumping. Let me actually go and set the chart or the chat proper. So we're going to insert a proper video. And then I guess a trading view on top, perhaps. Somebody who said we're pumping, you should go to jail for that because we're not. Yeah, I'm gonna do this. I'm trying some different stuff, all right? I'm trying to get this to you guys in the best way possible. Don't worry about it. It's gonna work. And it's going to look fabulous. Okay, I guess I'm not suited for this. All right, this is the best it's going to be. Gonna get. But I guess it will be doable enough. It's gonna look so scuffed. Oh no. I guess we tried. That's the most important part about it. That's the most important part about it. We tried. Does it look good? Absolutely freaking not. Is it funny though? Yeah, sure. It looks so scuffed. If we also only had one chart, this would be a significant amount easier. But I want two. I guess let's just do one chart, only the Bitcoin one. All right, 10 more minutes left. All we're doing right now is just waiting for the stream to start. I'm just trying to make the most beautiful screen we can with hopefully a chart of sorts inside. But I'm not a mastermind at planning this because, again, anything looks kind of stupid. So, yeah, I've been trying. Soul pump and dump. Let's see here. Soul going crazy, anybody? No, it's actually down 3% or so. Polygon is up 3%. I guess you can call that kind of interesting. The fact that Solana is down 3%, Polygon is up 3%. I mean, it's a lot more different than the majority of cryptos out there. Ethereum is up 1.7%. The rest of everything is just like moving ever so slightly. TON is down a little bit. ICP is up a little bit. Lido is down 4.5%. That's pretty significant. VeChain is down 3.5%. I met some cool guys over at VeChain, by the way. And I think two projects I might actually want to do, or I'm able to do some cool interviews with. So that could actually be something rather interesting. Yeah, so stay tuned for that, I guess. I think this will have to work. I'm not so sure how I can get rid of this edge still. There probably is a way to do it, but I don't know how. I guess if I open Google Chrome, perhaps. Or, here we go. I do it like that. There we go. That looks a lot better. Again, guys, if you're thinking I'm a stupid ass, understand I am. All right. I'm just struggling so much to put this all together. So in about 7 minutes, it looks really good because it's going to be a very important speech and I'm expecting some crazy wild volatility. So I want you guys to be able to see the chart. The only thing you guys have to put down is which chart you want to see. S&P, the dollar, or Bitcoin or XRP, whatever you want. Just let me know. Just let me know. Straight up. Let me know which one you're most interested in. Have a vote? All right, let's put it in. Let me do a vote. You're right. A poll. Which chart? Which chart should we keep up? BTC, XRP, DXY, SP 500. The community shall vote which chart we're going to be taking a look at as the FOMC meeting rolls in. All right, the results are hopping on in. And the majority has spoken for XRP, but that's not a very, very vocal majority. It's actually a very small percentage, 60%. I would have expected one of them, either Bitcoin or XRP, to win by crazy margins, but I guess that's not the case. Now I'm going to have to type really, really small here. For you guys, it might be huge. For me, it's like unreadable. So I'm just going to assume that this is the XRP chart, but this is not Binance. We want Binance. Yeah, I'm not able to see what it says. There we go. Here we go. There we go. There we go. We've got it. XRP chart is in. FOMC meeting starting in 3 minutes. We've got everything ready. Finally. Whew, I'm done with my charting and done with my setting things up. That took way too much time. Way more time than it should have. Way more time than I wanted to. But it's done. And so right now, hopefully, we're going to be enjoying our Jerome Powell speech. I sincerely hope so. My days. Another minute or so, maybe 2 minutes or so. Tank says, what's up, Dusty? And hello from Northern Ireland. Hey, what's up, my man? Yeah, right now, again, ooh, XRP falling down a little bit and Bitcoin falling down. I've got another Bitcoin chart open on this side as well. Let me just quickly put the proper Bitcoin one in. Let's go for this one. I'm just guessing. This is guesstimating. I think I have the right chart. I'm just keeping Bitcoin over on the side just for fun. But XRP, you guys want it. You guys voted for. So we'll keep that one open. I just got it on the side just to be sure. Hey, hello from Madeira, XRP holder. Yeah, so many people in Madeira that are heavily into crypto. That's so interesting. Northern Ireland. I think that's also one of the first times I've seen that in the chat. Oh, by the way, everybody, if you've not done it yet, make sure you press that like button. Why? Well, why not? That's all I got to say about it. Why not? Kane says, oh, wait a minute. Was that a bird? All right. It is officially, should be starting. Let me also quickly give you guys the quick rundown. We've already got the result. All right. The basis points have increased, or the number, the Fed's funds rate, has increased by 0.25% or 25 basis points. That number is already out. This whole speech is about what's going to happen in the near future with regards to, are they going to keep increasing? Are they going to stop these increases? And things of that nature. It's not a question of, hey, where will the interest rate go to today? Because we've already gotten that number. So please, everybody understand that. There we go. Okay, still music. Still music. There's some wonderful gems. Don't get it twisted, but I don't want to get striked for that. There we go. So once it starts, I'm going to take my my little camera away because you guys have requested it many times. And I might have to put on a headset. I'm not so sure about that. Again, what we're waiting for, what we're watching for, what we're listening to is Jerome Powell saying anything with regards to their future expectations. It's coming in hot, coming in hot, coming in hot, coming in hot, coming in hot. There we go. Everybody, if you enjoyed, make sure you press that like button. Let's go.
Before discussing today's meeting, let me comment briefly on recent developments in the banking sector. Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient. We will continue to monitor conditions in the sector. We're committed to learning the right lessons from this episode, and will work to prevent events like these from happening again. As a first step in that process, last week we released Vice Chair for Supervision Barr's review of the Federal Reserve's supervision and regulation of Silicon Valley Bank. The review's findings underscore the need to address our rules and supervisory practices to make for a stronger and more resilient banking system, and I'm confident that we will do so. From the perspective of monetary policy, our focus remains squarely on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by a 1/4 percentage point. Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are also continuing to reduce our securities holdings. Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. The pace of economic growth in the first quarter of this year continued to be modest at 1.1%, despite a pickup in consumer spending. Activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 3 months of the year, job gains averaged 345,000 jobs per month. The unemployment rate remained very low in March at 3.5%. Even so, there are some signs that supply and demand in the labor market are coming back into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. But overall, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in March, total PCE prices rose 4.2%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point, bringing the target range to 5 to 5.25%. And we're continuing the process of significantly reducing our securities holdings. With today's action, we have raised interest rates by 5 percentage points in a little more than a year. We are seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In addition, the economy is likely to face further headwinds from tighter credit conditions. Credit conditions had already been tightening over the past year or so in response to our policy actions and a softer economic outlook. But the strains that emerged in the banking sector in early March appear to be resulting in even tighter credit conditions for households and businesses. In turn, these tighter credit conditions are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of these uncertain headwinds, along with monetary policy restraint we've put in place, our future policy actions will depend on how events unfold. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will make that determination meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we are prepared to do more if greater monetary policy restraint is warranted. We remain committed to bringing inflation back down to our 2% goal and to keep our longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Gina.
Hi, Gina Smilik, New York Times. Thanks for taking our questions. I wonder if you could tell us whether we should read the statement today as a suggestion that the committee is prepared to pause interest rate increases in June. And I also wonder if the Fed staff has in any way revised their forecast for a mild recession from the March minutes. And if so, what a recession like what they're envisioning would look and feel like when it comes to, for example, the unemployment rate.
So, taking your question, of course, today our decision was to raise the federal funds rate by 25 basis points. A decision on a pause was not made today. You will have noticed that in the in the statement from March, we had a sentence that said the committee anticipates that some additional policy firming may be appropriate. That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to which additional policy firming may be appropriate to return inflation at 2% over time, the committee will take into account certain factors. So that's a meaningful change, that we're no longer saying that we anticipate. And so we'll be driven by incoming data, meeting by meeting, and we'll approach that question at the June meeting. So the staff's forecast is, so let me start by saying that that's not my own most likely case, which is really that the economy will continue to grow at a modest rate this year. And I think that's, so different people in the committee have different forecasts. That's my own assessment of the most likely path. Staff produces its own forecast, and it's independent of the forecasts of the participants, which include the governors and the Reserve Bank presidents, of course. And we think this is a healthy thing, that the staff is writing down what they really think. They're not especially influenced by what the governors think, and vice versa. The governors are not taking what the staff says and just writing that down. So it's actually good that the staff and individual participants can have different perspectives. So broadly, the forecast was for a mild recession, and by that I would characterize as one in which the rise in unemployment is smaller than has been typical in modern era recessions. I wouldn't want to characterize the staff's forecast for this meeting. We'll leave that to the minutes, but broadly similar to that.
Rachel.
Thank you, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I'm wondering if you can talk about the account of possible effects of a debt limit standoff. You've said repeatedly that the ceiling must be raised, but do you see any economics effects of even getting close to a default, and what type of situation would that look like?
So I wouldn't want to speculate specifically, but I will say this. These are fiscal policy matters, for starters, and they're for Congress and the administration, for the elected parts of the government to deal with, and they're really consigned to them. From our standpoint, I would just say this. It's essential that the debt ceiling be raised in a timely way so that the U.S. government can pay all of its bills when they're due. A failure to do that would be unprecedented. We'd be in uncharted territory, and the consequences to the U.S. economy would be highly uncertain and could be quite averse. So I'll just leave it there. We don't give advice to either side. We just would point out that it's very important that this be done. And the other point I'll make about that, though, is that no one should assume that the Fed can protect the economy from the potential, short and long-term effects of a failure to pay our bills on time. It would be so uncertain that it's just as important that we never get to a place where we're actually talking about or even having a situation where the U.S. government's not paying its bills.
And just to follow up, was discussion around the uncertainty of a possible standoff, did that affect today's monetary policy decision at all?
I wouldn't say that it did. It was, of course, it's something that came up. We talk a lot about risks to the outlook, and that come up. A number of people did raise that as a risk to the outlook. I wouldn't say that it was important in today's monetary policy decision yet.
Steve.
Chairman, thank you. Yeah, Steve Leisman, CNBC. Can you tell us what the Federal Reserve Board did in the wake of that February presentation where you were informed that Silicon Valley Bank and other banks were experiencing interest rate risks? And can you tell me what supervisory actions you've done in the wake of the recent bank failures to make sure that banks are currently appropriately managing interest rate risk? And kind of part three, but it's all the same question here. Do you still think this separation principle, that monetary policy and supervision can be handled with different tools? Thank you.
Sure. So the February 14th presentation, I didn't remember it very well, but now, of course, I've gone back and looked at it very carefully. I did remember it. And what it was a general presentation. It was an informational briefing of the whole board, the entire board. I think all members were there. And it was about interest rate risk in the banks and lots of data. And there was one page on Silicon Valley Bank, which talked about the amount of losses mark-to-market losses they had in their portfolio. There was nothing in it about, that I recall anyway, about the risk of a bank run. So it was, I think the takeaway was they were going away to do an assessment, a horizontal assessment of banks. It wasn't, it wasn't presented as an urgent or alarming situation. It was presented as an informational, non-decisional kind of a thing, and I thought it was a good presentation, and as I said, did remember it. In terms of what we're doing, of course, I think banks themselves are many banks are now are attending to liquidity and taking opportunity now, really since the events of early March, to build liquidity. You asked about the separation principle. Like so many things, it's very useful. But ultimately, it has its limits. I mean, I think in this particular case, we have found that the monetary policy tools and the financial stability tools are not in conflict. They're working well together. We've used our financial stability tools to support banks through our lending facilities, and at the same time, we've been able to use our monetary policy tools to foster maximum employment and price stability.
Mr. Chairman, I'm sorry. I don't mean to be argumentative, but the staff report said SVB has significant interest rate risk. It said interest rate risk measurements failed at SVB, and it said banks with large unrealized losses face significant safety and soundness risk. Why was that not alarming?
Well, I mean, I didn't say it wasn't alarming. It was, they're pointing out something that they're working on and that they're on the case. That I'm not sure whether they mentioned. I think they did actually. They mentioned that they had taken regulatory action, or supervisory action in the form of matters requiring attention. So I think that was also in the presentation. I think it was to say, yes, this is a bank, and there are many other banks that are experiencing these things, and we're on the case.
Thank you.
Go to Victoria. Hi, Chair Powell. I wanted to ask you, obviously, with the recent bank turmoil, we've seen multiple banks buy other banks, and I was just curious whether you think that further consolidation in the banking sector would increase or decrease financial stability, and whether you have any concerns about the biggest bank in the U.S. Getting even larger.
So, we certainly don't, and I don't have an agenda to further consolidate banks. Consolidation has been a factor in the U.S. banking industry really since interstate banking, and before that even. It goes back more than 30 years. When I was in the government a while back, I think there were 14,000 banks. Now there are 4,000 and change. So that's going on. I personally have long felt that having small, medium, and large-sized banks is a great part of our banking system. The community banks serve particular customers very well. Regional banks serve very important purposes, and the various kinds of GSIBs do as well. So I think it's healthy to have a range of different kinds of banks doing different things. I think that's a positive thing. Is it a financial? So I would just say, in terms of J.P. Morgan buying First Republic, the FDIC really runs the process of closing and selling a closed bank completely. That is their role, so I really don't have a comment on that process. As you know, there's an exception to the deposit cap for a failing bank. So it was legitimate, and I think the FDIC, I believe, is bound by law to take the bid that is the least cost bid. So I would assume that's what they did.
So, but do you have any concerns about the fact that they're getting larger in general?
So I think it's probably good policy that we don't want the largest banks doing big acquisitions. That is the policy, and but this is an exception for a failing bank, and I think it's actually a good outcome for the banking system. It also would have been a good outcome for the banking system had one of the regional banks bought this company, and that could have been the outcome. But ultimately, we have to follow the law in our agencies, and the law is it goes to the least cost bid.
Let's go to Colby.
Thank you. Colby Smith with the Financial Times. At the March meeting, you mentioned that tightening of credit conditions from the recent bank stress could be equal to one or more rate increases. So given developments since then, how has your estimate changed?
Yeah, I think I followed that up by saying it's it's quite impossible to have a precise estimate of the words to that effect. But in principle, that's the idea. You know, when we've been raising interest rates, and that raises the price of credit, and that, in a sense, restricts credit in the economy, working through the price mechanism. And you know, when banks raise their credit standards, that can also make credit tighter in a kind of broadly similar way. It isn't possible to make a kind of clean translation between one and the other, although firms are trying that, and you know, we're trying it. But ultimately, we have to be honest and humble about our ability to make a precise assessment. So it does complicate the task of achieving, you know, a sufficiently restrictive stance. But I think conceptually, though, we think that you know, interest rates, in principle, we won't have to raise rates quite as high as we would have had this not happened. The extent of that is so hard to predict because we don't know how persistent these effects will be. We don't know how large they'll be and how long they'll take to be transmitted. But that's what we'll be watching carefully to find out.
Just to quickly follow up, what does it suggest about the scope for the committee to pause rate increases perhaps as early as next month, even if the data remains strong then, if it's having some kind of substitute effect?
This is just something that we have to factor in as we want to find ourselves. So I guess I would say it this way. The assessment of the extent to which additional policy firming may be appropriate is going to be an ongoing one, meeting by meeting, and we're going to be looking at the factors that I mentioned that are listed in the statement, the obvious factors. That's the way we're going to be thinking about it. That's really all we can do. As I say, it does complicate. We have, you know, a broad understanding of monetary policy. Credit tightening is a different thing. There's a lot of literature on that, but translating it into rate hikes is uncertain. Let's say it adds even further uncertainty. Nonetheless, we'll be able to see what's happening with credit conditions, what's happening with lending. There's a lot of data on that, and you know, we'll factor that into our decision making.
Howard Schneider with Reuters. Thank you. So noting that the statement dropped the reference to sufficiently restrictive, I was wondering, given your baseline outlook, whether you feel this current rate of 5 to 5.25% is in fact sufficiently restrictive.
So that's going to be an ongoing assessment. We're going to need data to accumulate on that. Not an assessment that we've made. That would mean we think we've reached that point, and I just think it's not possible to say that with confidence now, but nonetheless, you will know that the summary of economic projections from the March meeting showed that at that point in time that the median participant thought that this was the appropriate level of the ultimate high level of rates. We don't know that. We'll revisit that at the June meeting, and that's, you know, we're just going to have to. Before we really declare that, I think we're going to have to see data accumulating and you know, make that, as I mentioned, it's an ongoing assessment.
A follow-up on credit, but could you give us a sense of what the SLUS survey indicated? It was already, you know, I think 45% of banks were tightening credit as of the last survey. What did this one show, and how did that weigh into your deliberations?
So we're going to release the results of the SLUS on May 8th, in line with our usual time frame. And I would just say that the SLUS is broadly consistent when you see it with how we and others have been thinking about the situation and what we're seeing from other sources. You will have seen the Beige Book and listened to the various earnings calls that indicate that mid-sized banks some of them have been tightening their lending standards. Banking data will show that lending has continued to grow, but the pace has been slowing really since the second half of last year.
Let's go to Nick.
Nick Tamaros of the Wall Street Journal. Chair Powell, the argument around the end of last year and the beginning of this year to slow down the pace of increases was to give yourself time to study the effects of those moves. After the bank failures in March, as you've discussed, the Fed staff projected a recession starting later this year. So my question is why it was necessary to raise interest rates today, or put differently, if the whole point of slowing down the pace was to see the effects of your moves, and now you've, for the last 2 meetings, been seeing the effects of those moves. Why did the committee feel it was necessary to keep moving?
Well, we The reason is that we, again, with our monetary policy, we're trying to reach and then stay at for an extended period, a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time. And, that's what we're trying to do with our tool. I think slowing down was the right move. I think it's enabled us to see more data, and it will continue to do so. So we really, we have to balance. We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right way to balance that.
And just to follow up, what you said in response to Howard's question, you'll need data to accumulate to determine if this is a sufficiently restrictive stance. Does that data need to accumulate, or could it accumulate over a longer period than a 6-week intermeeting cycle?
As I mentioned, I would just say that this assessment will be an ongoing one. You can't, with economic data, you can't. You've seen, take inflation for it. Look back. We've seen inflation come down, move back up 2 or 3 times since March of 2021. We've seen inflation have a few months of coming down and then come right back up. So I think you're going to want to see that, that a few months of data will persuade you that you've got this right, kind of thing. And we have the luxury. We've raised 500 basis points. I think that policy is tight. I think real rates are probably, that you can calculate them many different ways, but one way is to look at the nominal rate and then subtract a reasonable estimate of let's say 1-year inflation, which might be 3%. So you've got 2% real rates. That's meaningfully above what many people anyway, would assess as the neutral rate. So policy is tight, and you see that in interest-sensitive activities, and you also begin to see it more and more in other activities. And if you put the credit tightening on top of that and the QT that's ongoing, I think you feel like we may not be far off, or possibly even at that level.
Thank you very much, Chair Powell. Edward Lawrence with Fox Business. So if the Federal Reserve gets down to the 3% inflation, as the projections show at the end of this year, or close to it, would it be okay for you for a prolonged period of 3% inflation and hoping for some outside event to move down to 2% target?
I think we're always going to have 2% as our target. We're always going to be focusing on getting there.
Would you be okay with a prolonged 3%?
Let me just say that's not what we're looking for. We're looking for inflation going down to 2% over time. I mean, that's not a question that's in front of us, and it would depend on so many other things. But ultimately, we're not looking to get to 3% and then drop our tools. We have a goal of getting to 2%. We think it's going to take some time. We don't think it'll be a smooth process, and I think we're going to need to stay at this for a while.
How does the other side of the mandate, the jobs side, once you get to 3%, going from 3 to 2, how does the other side of the mandate balance?
I think they will both matter equally at that point. Right now, you have a labor market that's still extraordinarily tight. You've still got 1.6 job openings, even with the lower job openings number, for every unemployed person. We do see some evidence of softening in labor market conditions, but overall, you're near a 50-year low in unemployment. Wages, you all will have seen the wage number from late last week, and it's whenever it was, and it's a couple percentage points above what would be consistent with 2% inflation over time. So we do see some softening. We see new labor supply coming in. These are very positive developments, but the labor market is very, very strong. Whereas inflation is running high, well above our goal, and right now we need to be focusing on bringing inflation down. Fortunately, we've been able to do that so far without unemployment going up.
Matt. Hi, Chair Powell. Matthew Bosa with Bloomberg News. So many analysts noted at the time of the March FOMC meeting that at least half of Fed officials' projections did imply or seem to imply that a recession was in their baseline forecast as well, given the strong first quarter GDP tracking estimates. And so I'm just wondering if you could kind of elaborate on, why you're optimistic that a recession can be avoided, given that that's the Fed staff's forecast, possibly also the broader committee's forecast as well, and also, of course, most private sector forecasters.
Yeah, I don't think, I know what's printed in the Summary of Economic Projections and all that. I don't think you can deduce exactly what you said about what participants think, because you don't know what they were thinking for first quarter GDP at that point. They could have been thinking about a fairly low number. Anyway, in any case, I'll just say I continue to think that it's possible that this time is really different. And the reason is there's just so much excess demand, really, in the labor market. It's interesting, as we've raised rates by 5 percentage points in 14 months, and the unemployment rate is 3.5%, pretty much where it was, even lower than where it was when we started. So job openings are still very, very high. We see by surveys and much evidence that conditions are cooling gradually, but it really is different. It wasn't supposed to be possible for job openings to decline by as much as they've declined without unemployment going up. Well, that's what we've seen. So there are no promises in this, but it just seems to me that it's possible that we can continue to have a cooling in the labor market without having the big increases in unemployment that have gone with many, prior episodes. Now, that would be against history. I fully appreciate that. That would be against the pattern. But I do think that the situation in the labor market with so much excess demand, yet, wages have been moving down. Wage increases have been moving down, and that's a good sign, down to more sustainable levels. So I think it's still possible. I think. The case of avoiding a recession is, in my view, more likely than that of having a recession. But it's not that the case of having a recession is. I don't rule that out either. It's possible that we will have what I hope would be a mild recession.
The committee also noted in March that wage growth was still well above levels that would be consistent with 2% inflation. Do you see that as well? And could you kind of explain, how you come to that judgment?
Sure. So we look at a range of wage measures, and then that's a nominal. And then so you assume wages should be equal to productivity increases plus inflation. And so you can look at the Employment Compensation Index, average hourly earnings, the Atlanta Wage Tracker, compensation per hour, basically those four, and many others, and you can look at what they would have to run at over a long period of time for that to be consistent with 2% inflation. They can deviate. Corporate margins can go up and down, and there is a feature of long expansions where they do go down, where labor gets a bigger share toward later in a recession. Later in expansion. So yeah, and we calculate those, and you have to take the precision with a degree of salt. But I would say that what they will show is that if wages are running at 5%, 3% is closer to where they need to be. Wage increases closer to 3%, roughly, is what it would take to be consistent with inflation over a longer period of time. By the way, I do not think that wages are the principal driver of inflation. You're asking me a very specific question. I think there are many things. I think wages and prices tend to move together, and it's very hard to say what's causing what. But I've never said that that wages are really the principal driver, because I don't think that's really right.
Great. Chris Rugaber at Associated Press. Well, you mentioned profit margins. Those have expanded, did expand sharply during this inflationary period. And while there are some signs that they are starting to decline, many economists note they haven't fallen as much as might be expected, given that we're seeing at least some pullback among consumer spending. So speaking of causes of inflation, do you see expanded profit margins as a driver of higher prices? And if so, would you expect them to narrow soon and contribute to reduced inflation in the coming months?
So higher profits and higher margins are what happens when you have an imbalance between supply and demand. Too much demand, not enough supply. And we've been in a situation in many parts of the economy where supply has been fixed or not flexible enough. And so, the way the market clears is through higher prices. So to get, I think as goods pipelines have gotten, back to normal so that we don't have the long waits and the shortages and that kind of thing, I think you will see inflation come down, and you'll see corporate margins coming down as a result of a return of full competition where there's enough supply to meet demand, and then you're really back to full competition. That would be the dynamic I would expect.
Michael McKee from Bloomberg Radio and Television. Can you tell us something about what your policy reaction function is, your policy framework is going forward? When you look at the economy at the next meeting, are you looking at incoming data, which is by definition backward looking? Are you going to be forecasting what you think is going to happen? Are you ruling out the rate cuts that the market has priced in?
I didn't catch the last part. Ruling.
Markets have priced in rate cuts by the end of the year. Do you rule that out?
Okay, I got it. So what are we looking at? I mean, we look at a combination of data and forecasts. Of course, the whole idea is to create a good forecast based on what you see in the data. So we're always looking at both, and it will, of course, it'll be the obvious things. It'll be readings on inflation. It'll be readings on wages, on economic growth, on the labor market, and all of those many things. I think a particular focus for us going now over the past 6-7 weeks now, and going forward is going to be what's happening with credit tightening. Are small and medium-sized banks tightening credit standards, and is that having an effect on loans, on lending? And so we can begin to assess how that fits in with monetary policy. That'll be an important thing. We'll be looking at everything. It's, again, I would just point out, we've raised rates by 5 percentage points. We are shrinking the balance sheet, and now we have credit conditions tightening, not just in the normal way, but perhaps a little bit more due to what's happened. And we have to factor all of that in and make our assessment of whether our policy stance is sufficiently restrictive. And we have to do that in a world where policy works with long and variable lags. So this is challenging, but we will make our best assessment, and that's what we'll be thinking.
What about the idea of rate cuts?
Yeah, so we on the committee have a view that inflation is going to come down, not so quickly, but it'll take some time. And in that world, if that forecast is broadly right, it would not be appropriate to cut rates, and we won't cut rates. If you have a different forecast, and markets have been from time to time pricing in quite rapid reductions in inflation, we'd factor that in, but that's not our forecast. And of course, the history of the last 2 years has been very much that inflation moves down. Particularly now, if you look at non-housing services, it really hasn't moved much, and it's quite stable. And so we think we'll have to. Demand will have to weaken a little bit, and labor market conditions may have to soften a bit more to begin to see progress there. And again, in that world, it wouldn't be appropriate for us to cut rates.
Courtney?
Courtney Brown from Axios. I'm curious how you view the role of the overnight reverse repo facility in the context of the current banking stress. Do you think it's contributing to the stress by making it more attractive for money market funds to compete with banks for deposits? And did the committee discuss any changes to the structure of the facility, or do you see that being put on the table in the future? Thanks.
Sure. So we looked at that very carefully, as you would imagine, and it's really not contributing, we don't think now. It hasn't actually been growing. It moved up, it moved down, and then moved back up to where it was. What happened in the when there were the big deposit flows, which by the way have really stabilized now, what happened was institutional investors took their uninsured deposits and put them in government money market funds, which bought paper from the Federal Home Loan banks and things like that. Over the course of of maybe the last year, retail investors had been gradually, as they do in every tightening cycle, they've been gradually moving their deposits into higher yielding places such as CDs and other things, including money market funds. So that's a gradual process that is quite natural and happens during a tightening cycle. What was unusual really was the institutional investors moving their uninsured deposits and spreading them around and things like that. But it doesn't seem to have had any effect overall on over the overnight repo facility. That is really there to help us keep rates where they're supposed to be, and it's serving that purpose very well.
Sarah Ewald-Weiss, CBS News. I want to go back to the debt ceiling for a moment. I know you talked about that in terms of fiscal policy, but can you just speak towards what the impact of a default would mean for Americans across the country, the markets, and borrowing?
Yeah, I would just say it's. I don't really think we should be. We shouldn't even be talking about a world in which the U.S. doesn't pay its bills. It just shouldn't be a thing. And again, I would just say we don't. No one should assume that the Fed can really protect the economy and the financial system and our reputation globally from the damage that such an event might inflict.
Scott.
Thanks, Mr. Chairman. Scott Horsley from NPR. In his report last week, Vice Chair Barr identified a couple of the factors that he thought contributed to the the supervisory lapses at Silicon Valley Bank. A policy change in 2019 to exempt all but the biggest banks from strict scrutiny, and also what he called a sort of cultural shift towards less aggressive oversight. You were here in 2019. Do you share that view, and what would it take to get the stronger oversight that you and he said in your release would be necessary?
So I didn't take part in creating the report or doing the work, but I have read it, of course, and I find it persuasive. I mean, I would say it this way: a large bank, not a very large bank, a large bank failed quite suddenly and unexpectedly in a way that threatened to spread contagion into the financial system. I think the only thing that I'm really focused on is to understand what went wrong, what happened, and identify what we need to do to address that. Some of that it may just have been technology evolving, we have to keep up with all that, but some of it may be our policies and supervisory and regulatory, whatever. Well, what our job is now is identify those things and implement them. And that's kind of the only thing I care about and I feel like I am accountable for doing everything I can to make sure that happens.
Thank you. Evan Reiser with MNI Market News. Chair Powell, are we in the early stage or nearing the end stage of the banking turmoil among regional banks? And secondly, do you still have a bias to tighten rates? Is that what the statement is saying?
So, I guess I would say it this way. There were three large banks, really, from the very beginning, that were at the heart of the stress that we saw in early March, the severe period of stress. Those have now all been resolved, and all the depositors have been protected. I think that the resolution and sale of First Republic kind of draws a line under that period is an important step toward drawing a line under that period of severe stress, okay? I also think we are very focused on what's happening with credit availability, particularly, with what you saw in the Beige Book, and you will see in the SLOOS is small and medium-sized banks who are feeling that they need to tighten credit standards, build liquidity. What's going to be the macroeconomic effect of that? More broadly, we will continue to very carefully monitor what's going on in the banking system, and we'll factor that assessment into our decisions in an important way going forward.
Okay, Greg.
Thank you, Fed Chairman. Greg Robb from Market Watch. I just wondered if you've done any reflection on on your own actions during this crisis and leading up to it over the last, since you've been Fed Chairman, I think I've heard you say a couple of times that you deferred to the Vice Chair for Supervision. Do you think that was the right way to go about this? And yeah, comments on that. Thank you.
Sure. So let me say, first of all, I've been chair of the board for 5+ years now, and I fully recognize that we made mistakes. I think we've learned some new things as well, and we need to do better. And as I mentioned, I thought the report was unflinching and appropriately so. I welcome it, and I agree with and will support those recommendations, and I do feel that I'm personally accountable to do what I can to foster measures that will address the problems. So on the Vice Chair for Supervision, the place to start is the statutory role, which is quite unusual. The Vice Chair, it says, shall deploy policy recommendations, develop policy recommendations for the board regarding supervision and regulation of depository institution companies, and shall oversee the supervision and regulation of such firms. So this is Congress establishing a 4-year term for someone else on the board, not the chair, as Vice Chair for Supervision, who really gets to set the agenda for supervision and regulation for the Board of Governors. Congress wanted that person to have political accountability for developing that agenda. So the way it works, the way it has worked in practice for me is I've had a good working relationship. I give my counsel my input privately, and that's, I offer that, and I have good conversations, and I try to contribute constructively. I respect the authority that Congress has deferred on that person, including working with Vice Chair Barr and his predecessor. And I think that's the way it's supposed to work, and that's appropriate. I believe that's what the law requires, and but it isn't. I wouldn't say it's a matter of complete deference. It's more, I have a role in presenting my views and discussing, having an intelligent discussion about what's going on and why, and that's my input. But ultimately, that person does get to set the agenda and gets to take things to the Board of Governors, and really in supervision has sole authority over supervision.
I've been buying that token, by the way. I just wanted to let you guys know
if
the
you had any
FOMC
regrets,
one.
or was there anything that
You guys just sent me that it was live.
Decisions that maybe you regret now in light of
just
what's
$100
happened?
worth.
I've had a few.
That's about it.
Sure. I mean,
it ain't that deep.
Who doesn't look back and think that you could have done things differently? But honestly, you don't get to do that. Again, my focus is on control the controllable. As one of my great mentors used to always say, control the controllable. What we control now is make a fair assessment, learn the right lessons, figure out what the fixes are, and implement them. And I think that Vice Chair Barr's report is an excellent first step in that, but we've got to follow through.
Hi there, Megan Casella with Barron's. Did the possibility of pausing at this meeting come up at all, and how seriously was that considered? I'm curious if you can give us any color as to whether there were any initial concerns about raising rates again, or what those discussions entailed.
So support for the 25 basis point rate increase was very strong across the board. I would say there are a number of people, and you'll see this in the minutes. I don't want to try to do the head count in real time, but people did talk about pausing, but not so much at this meeting. There's a sense that we're much closer to the end of this than to the beginning. That, as I mentioned, if you add up all the tightening that's going on through various channels, we feel like we're getting close or maybe even there. But that, again, that's going to be an ongoing assessment, and we're going to be looking at those factors that we listed in to determine whether there's more to do.
I'm curious too how to interpret that and the changes to the statement. Is the bar higher now to raise rates at the next meeting, or would a strong jobs report or inflation print be enough to push the Fed to tighten again?
I don't want to. I couldn't really say. I just think I think we've moved a long way fairly quickly, and I think we can afford to look at the data and make a careful assessment.
And we'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. You mentioned mentioned a few times about the lessons you learned from the banking crisis, that you would learn the right lessons. What are those lessons?
Well, I just would start with something that's changed, really, which is the run on Silicon Valley Bank was out of keeping with the speed of runs through history. And that now needs to be reflected in some way in regulation and in supervision. We know now that we know it's possible. I think no one thought that was possible. No one had. I'm not aware of anybody thinking that this could happen quite so quickly. So I think that, that will play through. It will be up to Vice Chair Barr to really take the lead in designing the ways to address that. But I think that's one thing. I guess I would just say that then that we're going to revisit. It's pretty clear to me anyway. It's clear that we need to strengthen both supervision and regulations for banks of this size, and I'm thinking that we're on track to do that as well.
Can you be any more specific on stress testing or looking at banks that have specific concentrations in certain parts of the economy?
Yeah, that's what Vice Chair Barr's role really is, and he'll take the lead on that.
Okay, thank you.
Thank you.
Yeah. So that was interesting, to say the least. What the? So let's conclude here. Have we learned something today? No. Because I'm not going to say that this man lies, right? Because that's definitely not something I can prove. But I can tell you that this man is so all over the place. He says one thing and then a couple lines afterwards is, well, but obviously the other one. He says it's not like previous times. The economy is in a pretty good spot. He talks about all these numbers as if they... This is pretty useless again. Oh, this is so sad. It's because I really had hoped that finally he'd actually give us some realness, but no. A big nothing burger. A big of nothing. So, yeah, that's pretty sad. Yeah, have we learned something from this? I don't think so. I don't think so. Oh, so all the Forbes articles, all the Fortune articles were all saying, hey, he's going to tell us what they're going to do. But even after watching this entire thing, I'm not even sure exactly what their plan is going forward. I don't even fully know. Because the guy just makes it seem as if all is chill, all is good. They've got everything under control. Looking for the right measure for the right time, but it's just ironic. I'd say it's interesting. Did you just hear what he said about banks of this size? I mean, when he talked about, let's see here real quick. I'm just quickly looking at if some others are saying something interesting over on Twitter. Perhaps somebody fetched a nice little quote from there. Fed's Powell, quote, "We feel like we are close or maybe even there." Exactly. What you're going to do with that? Nothing. Fed Powell, there's a sense that we are nearing the end rather than the beginning. Today there was a lot of support for raising interest rates. Yeah, we knew that. It would not be appropriate to cut rates right now. Yeah, we knew that. Just looking to see if there's something interesting, but I am not sure. I'm not sure I find some. To be honest, it was a big nothing burger in my opinion. It was pretty wacky. People are calling him the champion over on Twitter. Rand says the takeaways from the most boring FOMC ever. He says, Powell doesn't acknowledge the banking collapse. No, he's basically saying it's all fine. Powell was focused only on the mandate of inflation and unemployment, of which the numbers and the reality of things don't necessarily match up. And 3, the Fed opened a door to stop future hikes, but will continue to hike as long as they can and as long as they deem necessary, which could be as long as they deem, because we don't know, right? That's so vague. Oh, this is one of the worst meetings I've seen in a good while. SUI is dumping, yeah, because it's a layer 1 on day 1. They always dump. It always happens. The big institutions, they get it for cheap, so they sell as they can on your ass. Lonely says, I don't even think he knows he was stumbling through the words when she asked, what were the lessons learned through this? But the thing is, he's also just a human, right? The guy's just spitting some stuff, but it's not like he's like he knows everything, if you guys understand my drift. He's just trying some stuff. At the end of the day, as I said, he's human. He doesn't know everything. He just has to BS his way through, and he did a pretty good job. But yeah, that's it for today's little live stream. Hopefully you guys all enjoyed it. If you did, make sure you press the like button. We're going to stream whenever some cool stuff comes up like this one. So yeah, make sure you press the notification bell on for all the most important updates. And I'll see you guys again in another crypto video or live stream of sorts, hopefully tomorrow. See ya.